All right, we'll call to order the meeting for the Oklahoma City Post-Employment Benefits Trust. The what?
You said the order to meeting.
Oh, call to order the meeting.
Oh.
Yeah, or I'm going to try to get Diane in order. The Oklahoma City Post-Employment Benefits Trust for Monday, August 14th, 2017. The first item that we have is approval of the minutes from the July 10th, 2017 meeting.
Second.
All in favor?
Aye.
Any opposed? Next item is presentation from Doug on our investment reports. We have two items. One will be the performance report for June 30th, and then there is the do we have a monthly report in here too? And then July 31st, yes. Okay. Doug, you're up.
Thank you, Mr. Chairman and trustees. I think we'll quickly go through the July 31st report and then speak in detail about the quarterly report, if that's okay. Sort of a time machine here, and spend much more time on the June 30 mid-year report if we could. So as we think back to July 31st, and one thing that I always like to look at on the market environment page, the one that with the charts and the tables on it, is take a look at performance on the daily index total return from the beginning of this year and really notice where performance has come from. The Russell 1000, which is large cap U.S. equities, is up substantially more than small caps. And we've also seen a really nice run for the non-U.S. equities as well, which has been an interesting change in the market and really a reminder of why we want to stay diversified. As we look at the aggregate bond index and the Bloomberg Barclays Global Aggregate Index, you can see the performance there has been modest, but that non-U.S. fixed income has outperformed U.S. fixed income because the U.S. dollar has become weaker, and that benefits you if you have assets denominated in foreign currencies. Now, looking down at the table below, the monthly market index total return, Russell 1000 is up 11.44%. The Russell 2000, which is small cap stocks, has lagged fairly significantly at 5.77%, while the best performing equity class of assets has been foreign at 18.30. Remember, the past 5 years, we have seen domestic equities outperform foreign by substantial margin, but we've stayed invested in that area. Now, looking down at the aggregate bond index, up 2.7, and the global aggregate up 8.96. You can see that returns for fixed income, given that we have a yield on a 30-year Treasury of less than 3%, have been fairly strong in terms of relative performance. Looking down at equity sector performance for the month, you can see that for the U.S. equity market, all sectors were positive. For the Russell 2000, the only negative sectors were telecoms and healthcare, and some impact on our small cap portfolio because of that. And the international equity, you can see how strong returns were there, except for healthcare on that side too. Now, when we see there's a certain amount of lack of dispersion from non-U.S. equity returns, and that's very common when you see currency movements, right? So when you have the dollar weakening versus other currencies, it's going to boost performance of all stocks, regardless of the sector. And when we look at the year-to-date period, you can kind of see just how similar the returns sector by sector are on the far right-hand side, which tells me visually that we've got a pretty strong dollar decline versus other currencies. And then if we look on the year-to-date performance on the U.S. equity side, really the only areas of weakness is, telecoms a little bit, energy, but especially on the small cap side has underperformed, which helps us understand some of the other returns in the portfolio. Now, when we go to the following page where we see total returns, the total fund composite was up 1.49% for the month. Again, we're on a very strong streak of performance here, very consistent since the end of last year. For the quarter, we're up 3.41. For the last 1 year, 11.28. And the actuarial assumption is up 4.91%. So that's a fantastic rate of return for us. In my mind, the risk is always taking too much risk in the portfolio, but we also have to balance the fact that we need to generate high rates of return. And while fixed income may traditionally be the lower risk asset, you can suffer losses in and bond portfolios if you see interest rates go higher. But what drives interest rates higher is inflation. And honestly, I'm not seeing a lot of inflation coming out of the economy right now. The biggest driver of inflation traditionally has been energy prices. And I think that we're in a different environment when it comes to energy prices right now. If you look at the economy, inflation is actually going down. Employment is still improving, but we've got a 4.3% unemployment rate, and the improvements in the employment figures are decelerating right now. So when it comes to safe places to invest, over the day, over the week, the year, we're going to see some volatility. In fact, we saw some volatility at the end of last year, emanating from all places, North Korea. But it seems that that has subsided over the weekend in early trading today. So remain diversified. If we look down the portfolio, Loomis Sales, aggressive bond manager, and if you look at their one-year return, 7.6%, while the index was down 51 basis points, and that tells us just how good their selection was. Now, to get to that one-year return, there were some rough periods in 2015 where their portfolio underperformed, but we're enjoying the benefits of that performance right now. Double-line bond, 1.80 versus negative 51. And recent comments out of the head PM portfolio manager of Double Line indicates that they are reducing risk in their portfolio right now. And I think that that's good to hear, right? I like to hear differing opinions from the managers because that means we're diversified. Lord Abbett, the high-yield portfolio, up 12.17 versus 11.24. And lo and behold, our diversifying asset has a negative return over the last year, and that's Hoisington. If you look at them, they're down 12.97%. Again, we keep a modest but diversified approach on fixed income. And when the rest of the world is increasing, remember that their portfolio is fairly high likelihood that they're going to be trading the other way. But when equities are going down, this is our asset that outperforms. Looking at the last quarter, 2.21 versus the index, and again, a strong month in the equity markets, you have a negative 1.2 versus 4.3. Remember, this is bonds, right? These are treasury bonds. So the assets held in this portfolio can have ups and downs through the month, through the quarter, through the year, but at the end of the maturity of the holdings of these bonds, they mature at par. And there's no credit risk in this portfolio, given that's invested 100% in treasuries. Again, a unique asset, one that we think plays an important role, and we need to keep in mind that when we see a loss in the portfolio, that there are times that it is our sole performing asset. Going down to the rest of the portfolio, the 500 index is performing as it should. The mid-cap index is performing fairly close to its benchmark. You can see over the last 1 year, Hotchkiss & Wiley up 19.84% versus 13 for its benchmark, despite giving up some returns over the most recent quarter, and Stevens up 13.6 versus 17.76 for the last year. And we're considering, and I'll get some more into this in the report, but as we look at the portfolio on the equity side, we've maintained that we want to have more exposure to active in mid-cap and small-cap, and I don't think that we quite went to the conclusion to have passive management on the small-cap side because we think it's the most inefficient market. But we're starting to think that possibly that might be something. If we look at that last 1 year, as of July 31st, 13.6 versus 17.76. And talking with portfolio manager last month, if you remember, coming into the first quarter of this year, fourth quarter of last year, this is a portfolio that was showing great improvement. But then they had a quarter where they underperformed by 2%, and they had, when you put that on the observation period, it dropped off a great quarter at the end, and so they went from looking pretty strong to not so strong. And again, in our eyes, we want to have balanced performance. So probably coming back in October with a little bit more thoughts on potential diversification on this segment of the portfolio. Causeway is our cautious, our value-oriented international equity. 19.66 versus 18.32 over the trailing year. And again, some spotty performance here, but again, they're committed value investors, which means that they're very, very stubborn, and they have a very long-term view. So that's the monthly reports. Go into the quarterly, the June 30 report here, and when looking at this, at the total fund, again, the the big questions are, is 70% equities too much? I think that if we're taking assets to pay expenses, if we're allocating additional assets to the portfolio, there's really no safe place to invest. Treasuries are fairly expensive, but not likely to go down. Bonds are not yielding very much right now. In historic terms, the bonds are not yielding a whole lot. And if we look at equities, they've had a very nice run domestically. If we look at international equities, they've started to turn around. If probably the best value in the marketplace are smaller U.S. companies. But again, that's not a tremendously comfortable trade to go into today, because we've been in an era where central banks around the world have encouraged, and I'm using that in a very understated way, encouraged investors to go into riskier assets. And they have done so since 2009, since the great financial crisis. And where investors pile into assets, they drive prices up. Where prices go up, future returns can go down. Now, the good news on the other side of that is that corporate performance in the United States is very, very strong. We're 70% through second quarter earnings reporting period, and earnings with 70% of companies reporting. Earnings growth over last year, 12%, which is fairly strong given the fact that the U.S. economy itself is growing around 2.5%. So U.S. corporations are doing very, very well. And if we think about the business environment, I know things are incredibly hectic and confusing in Washington, D.C., but the one thing that's being held out as being the most business-friendly is a tax cut in the corporate tax rate. And if that does happen, you look at smaller companies, if they cut taxes by 15% for corporate, that affects smaller companies more than it does larger ones, and you're looking at immediately a 15% improvement in bottom line, which would elevate stock prices. So that is a potential happening, probably not this year, maybe the first quarter or second quarter of next year. But again, that hope is out there for some type of strategic change to business taxes in the United States. So that being said, we'll go through the report here. As we go to page 12, I think that this is a good chart. When we're looking at this, where we see that we're at an all-time high right now, the assets continue to improve and grow. Again, more of this is due to cash flow than investment performance, but investment performance is doing its job as well. If we look over to page 14, assets do not change significantly. We've got 60% in U.S. equities. It's diversified between large, mid, and small, between growth and value. Core fixed income at 18%, international equity at 10%, our active duration at 8.5%, and high yield fixed income at 3%. This is a long-term oriented portfolio. This is a portfolio that is built to provide returns over long periods of time. And to enable us to do that, there is significant equity participation and equity risk in the portfolio. When you're looking at an equity portfolio at 70%, or a portfolio of 70% equities, 95% of your volatility is coming from the equities. Only 5% is going to be coming from fixed income. So as the equity market performs, then this portfolio will continue to do well. The equity market stumbles, then we are going to participate in that as well.
So you had mentioned that we might look at, just as we have the opportunity as we're managing cash flows to start to adjust that. What area would we look to adjust that in? Would we look to domestic or to international?
Well, I think if we go back over the last 5 years, domestic large cap equities have performed the best, and I think that on a relative basis they're the most expensive. So I like to sell expensive and buy cheap. So it would be coming out of the index fund. The S&P 500 index fund.
Okay.
That is the discipline that, when it's properly enforced, can really add real value, even above and beyond manager performance. Because if you're taking away from expensive, realizing profits, and then reinvesting it into cheaper relative assets, that's how returns are gone. Another way to think about that is that you take your returns from your high volatility asset classes and you reinvest it in low volatility, thereby putting it in the bank. And that works. Now, is the bank super secure right now? Well, yields are low. Bond prices are fairly expensive, but I don't expect them to fall off the edge of a cliff.
Okay.
So looking on page 15 shows you the individual manager breakdown, no significant changes there. If we go to page 16, $44 million at the beginning of the quarter. And if we look across the top line, we had income of $169,000, and we had appreciation of $1.1 million, giving us the $45.4 million at the end of the quarter. That's a pretty good quarter. Anytime that you can show appreciation of over $1 million during a quarter, I'm fairly happy with that. That's a significant rate of return. Going down, you can see where the return came from. Just over half of it came from the domestic equity composite. You can see that fixed income came in with almost $300,000 of gains, and 170 of that came from the Hoisington portfolio. Again, it will probably be the best or the worst performing bond portfolio out of this group, just given the nature of how it's managed. Looking down, you can see Hotchkiss had a negative quarter. The Vanguard mid-cap fund was modestly positive. Stevens was $189,000 gain, and then Causeway, the international equity, at $226,000 gain. I like this page. I don't think we pay enough attention to the dollars that we're earning, and it really puts a lot more understanding about what the percent returns actually translate into. So looking on to the following page, page 17, the top line you can see for the quarter up almost 3%. For the trailing 1 year, 13%. I don't think we can minimize that. You were in the 19th percentile of the public funds universe of assets that are less than $70 million. Again, we can slice and dice this universe in many, many ways. Looking at the 3 years and the 5 years, you can see, and the 7 years, you can see how significantly we have improved recently with the new structure, with the new diversified fixed income portfolio. Looking down the list, you can see really where the best returns were for the last 1 year. Loomis, again, up 8%, index down 31 basis points. That's first percentile. So they were the top performing bond portfolio over the trailing year. Double Line was up a quarter of as much, but they're in their 8th percentile. So you had 4 times the outperformance from Loomis that you did in Double Line, but Double Line still outperformed 92% of fixed income funds in this universe. So it gives you an idea of just how strong Loomis's returns were. Lord Abbett was in the 10th percentile with 13.67. Again, Hoisington diversifying. If you look at them, down 926 in the 98th percentile, but then for the quarter up 509 in the 3rd percentile, and that gives you an idea of about the range that they will perform in relative terms. The Vanguard 500 index up 1774 for the year, the mid-cap up 1711. Hotchkiss up 23.5 for the trailing year. That's in the 12th percentile. And then our growth, small cap growth, here at 18.1 and 86th. And then 20.71 for Causeway. Taking a look at this, I hope we can repeat this result. But odds are that next quarter when we come in, this will be a lower return for the year. This is a really, really strong return. And the portfolio was allocated as it by target, but these results are very, very strong. But from an allocation effect, meaning 70% to equities, and then also our fixed income portfolios outperformed their peers by substantial margins, except for our risk diversifier. Looking at here on page 18, one figure I'd like to point out here, looking at Loomis sales, again, I said we had a great result so far over the last year to date, but then looking back to 2015, remembering that the first year that we had them, calendar year, it was very difficult because they were investing early in bonds in the energy sector, and that really hurt the portfolio returns at the very early stages, but they have more than recovered that uncomfortable period of returns. Going through the following pages, I want to spend a little bit of time on portfolio structure. If you'll bear with me here, I want to talk a little bit about each of our investments here. If we go page 19, Loomis sales, this is about 10% of the plan's assets. You can look at where they are allocating If you look on the left-hand side at the very bottom, you can see that they have 25 or 23% of the assets in maturities of less than 1 year. The next sectors are 5 to 10 and 1 to 3. And all of that rolls up into a duration of 3.4, meaning that if interest rates go up 1%, they're going to go, this portfolio's value will decline by 3.4, and vice versa. The index that they're compared to is almost 6 duration, so they are very low risk when it comes to duration risk, but if you look at where they're allocating here, they are different from the marketplace in the fact that they do hold foreign currency denominated bonds, which helped them dramatically during the quarter. They're also investing in lower credit rated bonds, but I think that if any shop out there has the ability to pick bonds, it's Loomis Sayles. Looking at the organization as a whole, they are very strong. The results on page 20, you can see how strong they are versus their peers. Those blue columns that are shaded in different colors tell you where the universe of most bond managers are over that period of time, and when you have the blue dot that represents Loomis Sayles significantly higher than the blue box, that means that they're outperforming more than 95% of their peers. But again, 2015 on the right-hand table over there, very, very difficult time. Glad that we were able to have the courage to stay with Loomis Sayles, and they have performed very well for most of the clients that I have. Double line is the next page. You can see that they're more, or they are less aggressive when it comes to credit. Their average credit rating is AA. Their duration is slightly longer at 5.23 years. And while they look a little bit weak when it comes to Loomis Sayles, remember again that they're outperforming over 92% of the other fixed income funds out there. So when we combine these two as our core fixed income approach, Loomis Sayles is a little bit more aggressive. Now, I would say that they are more aggressive on the credit side than Double Line, but Double Line has a very keen eye to reducing the risk profile when they think that there's a lot of risk in the market. So we think that those two play together very, very well. And then Lord Abbett on pages 23 and 24. This is managed by Steve Rocco and Rob Lee, and this portfolio has a yield of 7.3%. Its credit rating, average credit rating is B, which is below investment grade. And remember, this is our junk bond portfolio. They're concentrated, fairly short maturity, and they're concentrated in the double B and single B. Almost 70% of their portfolio is focused there. They could be investing in triple Cs, double Cs, et cetera, higher risk bonds, but as you can see right now, they have migrated the portfolio to the less risky part of the high yield market. And you can see how strong their returns have been. They're actually outperforming their benchmark, which is a tremendously difficult feat given how that portfolio is constructed. Page 25 is the Wasatch Fund. Again, this is sub-advised by Hoisington, which is a firm out of Austin, Texas. All of their portfolios invested in treasuries. All of their portfolios currently invested in 30-year treasuries. Their notion is that interest rates are not going higher, that if the economy does stumble through here, that you could see yields on a 30-year treasury down in the below 2%. We're at 274 today. Remember, anytime that there's a lot of volatility or risk or potential catastrophe in the world, Treasury bonds are the safe asset of choice. So anytime the equity market is hit by waves of selling, a lot of those dollars go into this, which does still yield. And in our mind, this is the most effective hedge that you can have to equity market volatility. So I continue to keep it in most of my client portfolios that are allocated similar to yours. So the 30-day yield on this as of June 30 was 3%. The duration is 23 years, meaning if interest rates go down 1%, this portfolio will gain 23% in market value. But again, not a lot of trading in this. If they do see inflation coming, they'll go to 91-day T-bills, and they will be able to make a significant profit doing that. So this is an unusual portfolio, but then one, again, that worked with them for well over a decade. I'm familiar with the return patterns. And again, this is the hedge to equity market risk, the most effective hedge that I've seen. And the nice thing about it is that you're paid 3% a year to invest in this at current yields. Going into the equity portfolios, kind of make sure I'm keeping a good pace here. On page 27 is Vanguard 500 index, very low turnover, very low cost here. Looking at the 5 largest names here, Apple, Microsoft, Amazon, Facebook. Going down that list, Johnson & Johnson, ExxonMobil, Berkshire Hathaway, JP Morgan Chase, and Alphabet, which is the old Google. I didn't know this, but one of the reasons that they named it Alphabet is that they have a division of the company that starts with every letter of the alphabet now. So Google with G, the one with X is where they do all their experimental work. I had no idea that they had divided themselves up into that many. And Alphabet as a company now is less about innovation than about buying other companies and using their innovations and then potentially selling those off. So that is the S&P 500. You'll see that the PE ratio is 26, so that's higher. The yield on this portfolio is 2.39. Earnings growth over the last 3 years has been 11.84. So low interest rate environment, high growth environment as far as earnings go, can support higher PE ratios, but again, 26, that's on the high end of history. So again, if we're taking assets and reallocating, this would be the first place that I would look to do that. Hotchkiss & Wiley is on page 29. 59 holdings in this portfolio, average market cap of about $9 billion, which is much smaller than the S&P. If you look at their PE ratio, 25.6, so they're on the higher end. Their earnings growth is lower. And you look at the names on the right-hand side here, Popular, Aris International, Goodyear Tire and Rubber, Whiting Petroleum, and Corning. So these are names that are either on their way up or names that were much larger at one time but have sold off and represent significant value. You'll see that their allocations on the lower left-hand side. Energy is the one area here that they are overweight the market, and if the rest of the world shows disdain or hate for a sector, that's where Hotchkiss & Wiley is going to be looking. So patience is a requisite for this, and I think that when we were repositioning the portfolio, we took that into very, very strong consideration, and that's why we have a passive complement to this portfolio. It gives us more patience. We think one of the, in a behavioral sense, when you have passive portfolios, you think much less about coming out of the marketplace. You know, if you are the market, you stay in the market rather than considering coming out. And one of the reasons that we have this passive complement to Hotchkiss & Wiley is because we want to be invested in mid-caps. And hopefully that passive allocation gives us a little bit more patience with occasional underperformance from Hotchkiss & Wiley. But if you look over long periods of time, Hotchkiss & Wiley has done very, very well. If you want to think about how they invest in companies, take a look at the 9th out of the 10th largest holding, Ericsson Telephones. You remember when Ericsson was one of the leading telephone manufacturers back when Nokia was big before Apple came in and took over that marketplace, Apple and Google. But they're still finding that they can manufacture and produce value for investors, even on Ericsson telephones. Looking at the results over the last year, they've been great. Over the last 2 years, we've had some volatility, but for the year 2016, they were in the 23rd percentile. Now looking at our mid-cap index fund on page 31, 358 holdings in this. Remember, we have 358 here, but we have less than 60 in Hotchkiss & Wiley, and we look at our largest names here. You've got Electronic Arts, which is a video game company. I think we all know how big video gaming is and how strong some of those companies are. Looking down in the names, we've got a little bit more technology. We've got some financials in here. In fact, financials is the largest sector, and North America is the largest sector. This portfolio has an average weighted market cap of $14 billion. So Hotchkiss is smaller. They're investing in deeper value companies, and the correlation between these two portfolios is fairly low when it comes to mid-cap. And when I look at page 32, what I want to see is I want to see the blue dot and the gray dot very close to each other, and we see that across the board. Stevens Small Cap is one we've been thinking about quite a bit. Again, it seems to be sort of 2 steps forward and 1 step back. And like I said earlier, we're really putting some thought into maybe complementing this portfolio with a small cap index fund to sort of reduce some of the market volatility there, or the non-market volatility. And again, October will come back with some additional work. Talking about this, again, I'm not 100% on where we're going here, but it looks like it might be a slightly less volatile way to get exposure to small caps. But again, small caps are where you can add a lot of value through active management. And I don't want to give that up without some additional study. Looking at the names here, Icon PLC, Parexel International, WageWorks, CoStar, Euronet, they're investing in the right places, so healthcare, technology, industrials even. But some of their healthcare names stumbled during the quarter. There was a position in the portfolio which they think will lead to a fraud suit because there was misrepresentation at the IPO. But again, that'll take years before that comes back to the portfolio, and we're not here to be patient and wait for years for lawsuits to drive returns.
Doug,
Yes.
I was looking at the price to earnings.
Yes.
Any comment on that?
Yeah, PE ratio for small cap earnings can be extremely high. This is on the high end of that. If you look at some of the companies that they're investing in, and the way this portfolio is structured is, I won't say it's unique, but it's unusual. They've got about half the portfolio that they invest in what they call their core growth companies. So these are larger companies that are a little bit more stable, that have better visibility on their earnings going forward. But they've got half the portfolio that's invested in what they call up-and-coming stocks. So these are the ones that are very highly priced. These are the ones that are high momentum stocks, which in this part of the world, sometimes growth you have to pay up for. These are higher momentum names also, and that leads to a PE ratio of 43. That's pretty high. Yeah, that is pretty high. But you look also at the 5-year EPS growth, 17%, right? 17% earnings growth is also very, very strong. In an environment where the U.S. GDP is up 2.5%, to get earnings growth like that, it will be expensive when you're looking at that. And where is that coming from? That's coming from the technology. It's coming from some consumer discretionary. They have pulled back their energy exposure after realizing some nice profits there. But again, industrials is sort of a weird part of the marketplace. It's mischaracterized sometimes. But I think that small caps are very, very underappreciated right now, especially versus large caps.
Well, I was just looking at the performance over a 5-year period compared to the benchmark and looking at that PE, and it's really high.
It is. And again, this is what leads us to think, do we want to be investing in small cap growth? And I think it's a good place to be invested. And I know I say that this is a more cautious small cap growth than most, and that's kind of hard to reconcile with a PE of 43. But I still think that they're good long-term investors. I want to stay invested here, but I also understand that sometimes, being this far away from the market over a 5-year period of time is tough. When we looked at them last quarter, they were improving. They were coming around, and I remember talking to not only you guys, but my colleagues saying, finally, Stevens is starting to come around. It really has been 2 steps forward, 1.5 steps back since we've been invested with them.
It's just kind of hard to fathom that you're paying that much for the stocks, and the performance is, they've underperformed the market over a 5-year period.
And also remember that we're in an environment where markets or investors have swung wildly from wanting to invest in very safe companies. 3 years ago, it was all about dividends and safety. And then last year, or a year and a half ago, they started going for growth. And especially right after the election last year, there were some pretty amazing switches going on in the marketplace. So to your point, we talked about this recently. I want to recommend that we place this firm on alert, not necessarily that we're moving away from them, but just that we are looking at them very, very carefully. And I think that reminds us, and it serves a good purpose. And again, thinking about where do we want to be invested? We want to be all active in this part of the marketplace, and I think active can provide excellent returns here. But I also want to recommend that we think about, okay, so how can we reduce some of the swing, positive and negative versus the marketplace? And I think we've made that decision on large caps and mid caps. But additional study, I want to put some additional time into that. So I'll leave the recommendation to place them on alert as it is right now, and move on to the next pages here. Let's see, Causeway. One of the things I like about Causeway is that they are fairly courageous when it comes to investing in companies that are not doing very well, but they see long-term positive future. If you look at their largest position at 4.2%, Volkswagen. If we remember, they're on a very large emissions scandal, that they were not a large investor in Volkswagen until the emissions scandal came in, and they thought that, having the value of a company based on a potential penalty was probably excessive, and that's when they buy in. We look at this portfolio, the yield, the dividend yield on this portfolio at 2.95. You get a higher yield on this and growth than you do if you're investing in 30-year treasuries. And if you look at where they're allocated in the marketplace right now, emerging markets, Asia, just to translate that into China, North America, Pacific ex-Japan, not a lot there, but then you look at Japan, they're underweight there. United Kingdom, of course, in the aftermath of the Brexit vote, they're going to be investing in Britain as other investors flee. If you look down the list of their holdings, Volkswagen, AkzoNobel, Royal Dutch Shell, BAT, British American Tobacco has been a long-term holding here, ABB, Schneider Electric, China Mobile. So you can see that they're selecting individual companies, and their PE ratio is 22 times. Again, interesting portfolio. I do like the emerging markets exposure here to give some additional exposure to long-term growth. But again, they're buying companies that they think are undervalued by a significant margin. And sometimes that does look a little bit strange on the PE ratio if they're buying, especially if they're buying cyclicals. The next pages are pages 37, 38 show us where performance has been. On page 37, we would expect Loomis Sales to be the most volatile and the strongest performer over the long term. And you can see how performance here does vary, that we get a lot of diversification out of Hoisington. Page 38 shows the returns here of the actual funds over long periods of time. And you'll note here that since 2003, or 2013, 12, 13, we have seen some underperformance from international equity. And there will be a reversion to the mean at some time in the future, and that's why we remain patiently invested there. What is unusual on this page, in my mind, is how close the performance of the U.S. equity portfolios that can go back this far are. Normally, we would see a wider dispersion of returns over the last 10 years. But here, they're pretty close together, and they're all very, very strong over that period of time. You can see that on page 39 is the correlation. And remember, correlation of +1 means perfect positive correlation. Correlation of -1 means perfect negative correlation. If we look at column D, which is the one for Wasatch, we do have negative correlation with that portfolio versus our equities, and that is a fantastic diversifier. And then page 40, recommend one change here, putting Stevens on alert, and then we are going to be studying, adding potentially some passive exposure to this part of the portfolio. Our fees on page 41, looking at where the fees for the investments are, you can see that the weighted average here, expense ratio is 44 basis points versus the category average of 72, difference of 28 basis points, and that gives us annual savings of $103,000 at current asset levels. Then page 42. Equity portfolios are right on target. Our fixed income portfolios are within range. And again, we've been allocating more to Hoisington, given that that is our diversifier. In my mind, if you still believe in the manager and they're underperforming your other assets on a relative basis, that's where capital should be flowing. But again, very close to our targets at all on the domestic, on the equity side. Pages 43 and 44 are the longer-term results here. We show only the returns that are actually experienced in the previous pages, and we'll be adding these to the flash report going forward to give us a longer-term view. So looking down, Loomis sales over the last 15 years, 849 versus 448. Lord Abbott, 865 versus 892. Again, very difficult to outperform. Our Hoisington, 762 versus 448. Annualized rate of return, the index fund at 822 over 834. Vanguard Midcap, 996 versus 1022. Hotchkiss & Wiley, 1055 versus 1050 versus 876 for the Midcap median manager. Stevens doesn't go back quite that far. Causeway, 710 versus 631. And these are all net of fees. So that concludes the extended version of the quarterly reports. I don't want to gloss over the strength of the return over the last year, 13%. Fantastic. Outperformed our actuarial assumption by a significant margin. Recognize also that we're relatively high allocation to equities. That's because this is a long-term portfolio and we have a very significant unfunded liability that we're trying to make up some ground on, given a long runway, a long investment horizon. And the area that we're going to be focusing on going through this quarter is going to be the small cap portfolio. So happy to take any additional questions.
So Doug, if you look back on page 17, where we do our comparison to the, where it includes the comparisons to the industry, basically.
Yes.
If you look back on our 3-year, 5-year, 7-year, like on that top line there, we're in the 91, 95, 99 percentile. Does our current makeup that we have now of managers, would that put us, because obviously we've made some change over the last couple of years, would that put us in a better standing on those? I mean, that's like, we couldn't have worse.
Right. Two things. Remember back, we go back to the 7-year period of time. So, does math work? So remember that we were much lower risk at the inception of this portfolio than we had the policy ability to do because we're coming out of the great financial crisis. So we missed the fastest and strongest outperformance of equities at that period of time, and we were doing that because we thought it was more prudent. And it was a very tough time to invest in equities because we thought the world economy could be, that's the closest I've ever seen to potential world economy or financial economy going down. So that would have hurt. If we did have, over the last 3 years and 5 years, we did increase our allocation to equities, right? So that would have helped because equities have outperformed fixed income significantly. And if we look back over the last 3 years, I think the last 5 years would probably improve the most, given our current structure. Because remember, we had FIA Seraphim, which was a very low risk, large cap U.S. equity, that we replaced with the index fund, right? So we would have had index performance and a higher allocation, so that would have improved performance. And our fixed income over the last 5 years, I think combined would have been very, very strong. Now, the 3 years, given how tough 2015 was for Loomis sales, I don't think the improvement would have been quite as strong. But I think over the last 5 years, the improvement would be definitely out of the 4th quartile, definitely out of that 90th percentile. Let me throw together just some figures, see what it would have looked like over the 3, 5, 7, and 10-year period.
Yeah, just to see that we're, like you say, that we were more conservatively invested at that time, but to see that we've got a track now that puts us in a better position going forward.
I think that we're definitely seeing some positive when you look at those. But yeah, I can simulate what it would have looked like over that period of time if we allocated this way. That's interesting.
Okay. All right, are there any other questions? All right, then I would take a motion to receive the monthly preliminary performance report for June 30, 2017, and for July 31st, 2017.
So moved.
All in favor? Any opposed? Great. Thank you, Doug.
Thank you, Mr. Chairman and trustees.
Next up is the interim financial statements, and Jake Siebenaler from Accounting Services. How'd I do?
What?
How'd I do?
Close. Steve Lawler, but you're close. Close enough. I know. It's a bear.
It's like it's stuck in my brain or something. I don't know.
Yeah, it's
Sorry
okay.
about that.
Good morning. Thank you. We just want to highlight a couple items out of your interim financial report. So I want to start on page 3. We just want to show at the end of the fiscal year, reporting fund net position of $49 million. This is an increase of 6.7 over the prior fiscal year. In comparison to that same prior fiscal year, contributions have decreased $1.8 million. Our net investments have increased $5.4 million, and deductions paid have increased $116,000. In the current year, the net position has gained $6.7 million, which was an increase over the $3.29 million gain in the prior year. The next page we want to flip to is page 10. It's in your notes section. On this page, we're looking at your money markets. At the end of the fiscal year, we're reporting money markets of $4.76 million. This is used to pay claims for our retirees, and this is compared to $5.5 million in the prior year. Currently, we're in the process of implementing the new GASB standards for this report, so you notice that we've kind of gained some pages in this one. We're up to 20-some-odd pages. As soon as our actuarial data comes in, we anticipate adding probably not 3 or 4 information as far as employee contributions and retiree rates and that kind of stuff to it.
And remind me, so for the new GASB standards, and I can't remember which one applies to
74
applies to the Opebt trust.
Yes.
That we will recognize the full liability on the fiscal year 17
Yes.
report for the trust, and then next year for 18
We
on
implement
75.
and that will hit the city's financials.
The city's financials,
Yeah,
okay.
The first year we do the trust, the second year we do the city. It kind of mirrors, if you're familiar at all with the one that we implemented for the retirement system.
Right,
It's kind of the same implementation.
right. Okay,
We're currently on that. We've been working with the actuarial data to make sure we get all that stuff, everything finalized and corrected with them. And as soon as we get their report, then we'll go through and issue a preliminary report for you guys to see at that point before we'll do the audited financial that'll go to the auditors.
okay.
You guys have any questions at this point?
All right. Thank you, Jake.
Thank you.
Stephen Aller. All right, I'd take a motion to receive the financial report for June 30, 2017. Well, we didn't really have anything that we were going to cover on that. We didn't have any changes that we were going to recommend on 5. So I have a motion.
I'll second.
Okay, all in favor? Any opposed?
To 4. I thought that Doug was talking about recommending to put Stevens on alert.
Yes.
But I don't
And he will put them on alert, but we don't take any action on that.
Okay.
So that won't change anything on allocations. So that was just more of their reporting to us and communications with the manager. Next item, item 7, is to ratify the claims listing. Take a motion.
Okay. Second.
All in favor? Any opposed? Last item is any reports or comments from staff or from trustees? And without any additional information, then we will be adjourned.